Hello and greetings. This is Brant Speshart with Steward Wealth Strategies. I hope this message finds you and your family staying well and enjoying the start to the holiday season. Welcome to our quick webinar on proactive year-end tax planning for 2023. Remember, a proactive approach to your tax planning instead of a reactive approach could produce better results. So, an educated client is our best client. This is one of the reasons we host these webinars, share information in workshops, newsletters, and articles, because we truly believe in stewardship. Stewardship is not only in the name of our firm, but it is also one of our core values here at Steward Wealth Strategies. And we want to help you be good stewards of the resources you've been blessed with. And by being a good steward with your financial plan, it's not just focused on retirement income or investments or estate planning or protection, but it's also having a game plan when it comes to the area of tax planning. And also, here at Steward Wealth Strategies, we believe that generosity should be a key component of every client's financial plan. So tax planning is not tax preparation. Tax preparation is where you look back and see how you did the prior year. Tax planning, though, is where we look forward, maybe the short term or long term, or maybe even the next generation. How can we reduce our future tax liability? So for 2023, there are still 7 tax rates. But here's something we all have to be aware of. This is scheduled to phase out when the Tax Cut and Jobs Act sunsets at the end of 2025, and we start new in 2026. Right now, though, we still have a very high standard deduction. Most Americans are not itemizing right now. You can see right here, a single filer, $13,850 for standard deduction. Married filing jointly, $27,700 is a standard deduction. And there's an increase based on certain circumstances and age requirements that are met. So how do we attack, or how do we view itemized deductions? You know, the old rule, it used to be, hey, accelerate your deductions. Try to claim as much as possible every year so that you could take the deduction. Now, though, it's really more of a timing or planning your deductions is the strategy. And we see this a lot right now with charitable giving. We've talked a lot about charitable giving strategies over the past few years. We recently recorded a webinar on charitable giving for 2023. And a lot of times timing or planning is how we're able to actually itemize and maximize those deductions in this current high standard deduction environment that we're in right now. Long-term capital gains rates are still very favorable. Most Americans are paying less in long-term capital gains rates than they are in their income tax rates. I mean, you can see this for a married filing jointly household. You could have income up to $553,000 and still qualify potentially for a 15% long-term capital gains rate. And that also applies to qualifying dividends as well. Now, sometimes we sell investments intentionally to harvest a gain or harvest a loss. When you harvest a gain or a loss, you actually sell an investment intentionally to lock in a gain or to lock in a loss. Why would you do that? Well, if I do it intentionally to lock in a gain, I may be doing it because I'm trying to take advantage of these low long-term capital gains rates. Maybe there's something that's going to go on in the future that's going to have me in a higher long-term capital gains bracket. Maybe I'm retired right now with limited income and I actually qualify for 0% long-term capital gains. Who does not love 0% tax rates? So sometimes it makes sense to lock in a gain now and declare it on our tax return. However, though, you got to remember, though, there's a trade-off when you do that, because when you lock something in, you're deciding to pay the tax now or declare the gain now, and you're losing on that tax deferral going forward. If you have losses, hey, losses can help offset gains, and you're actually able to carry over a $3,000 capital loss that would actually help count towards offsetting income. So there can be some advantages. Now, none of us like to lose money. We never want to have losses, but we want to be strategic and making sure that we're taking losses or gains at the right time if it's necessary, as part of our stewardship to make sure that we're doing proper tax planning. Review your retirement contributions. Know that if you're trying to max out your IRAs, know that if you're trying to max out your 401ks or your retirement plans through work, that there are limits on how much you can contribute, and it's different depending on the type of retirement plan, but also know that there are date restrictions as far as when this can take place. Generally speaking, if you work for an employer that has a retirement plan, those retirement plan contributions happen during that calendar year. Some accounts like IRAs, Roth IRAs, you can go up until your tax filing deadline of April 15th. Check with your tax preparer, or check with your financial advisor, or check with the HR department at your employer to see what timing restrictions there are or deadlines there are for the type of retirement plan contribution you're wanting to make. Roth IRA conversions. We talk a lot about Roth IRA conversions here at Steward Wealth Strategies. We really think Roth IRA conversions are very important to consider. Roth IRAs allow your money to grow tax-free. Roth IRAs are not subject to required minimum distributions. Roth IRAs are also tax-free withdrawals for beneficiaries. And the more tax-free income we have, that can also lower our overall taxable income over our lifetime. However, Roth IRA conversions are really important when it comes to legacy management. Am I in a higher tax bracket right now, or are my heirs in a higher tax bracket? If something happens to me, will my spouse be in a higher tax bracket eventually, to where it might make more sense for us to convert money to Roth? Or will my children, when they're in their peak earnings years and they inherit from my wife and I, would it make more sense for us to consider converting if we're in a lower tax bracket? This is very individualized. It depends on what your goals and objectives are, but it also depends on your family's overall tax bracket. So we have to take into consideration where you're at today, what are you trying to accomplish, but where are your potential heirs or beneficiaries, and does it make sense to try to mitigate how much the IRS is going to be part of your legacy? So the annual gifting limit for 2023 is up to $17,000 per donee. So I'm allowed to give up to $17,000 to any individual that I want, and my spouse is allowed to do that as well. So for a married couple, you could technically give up to about $34,000 without having to worry about exceeding the gift tax exclusion. You can also make payments directly to medical institutions to help pay medical bills. That doesn't count as a gift. Same thing when it comes to educational institutions. That does not count as a gift as long as it's handled the right way. If you have a generous heart and you like giving to individuals, make sure you don't exceed this amount. However, if you do, that's okay. Look, the Lord loves a cheerful giver. If you want to help somebody, that's fantastic, but just make sure you notify your CPA. That way they can process the proper documentation to report the gift. Doesn't necessarily mean that it's going to be taxable. It just needs to be recorded properly. Now, the annual gift is up to $17,000 per year. However, there is a lifetime amount that we're looking at, and this is the same amount as far as the estate tax. So right now, under the Tax Cut and Jobs Act, we're at about $12 million as far as the current exemption for the estate tax, as well as the lifetime gift. Here's the thing, though. In 2026, that exemption is set to sunset, and it's going to be cut in half roughly. And if you look at this, the bottom of this chart, the estate and gift tax rate, look at that. Federal alone is 40 and will soon be 45%. So if you have high net worth because of investments, assets, paid for home, 401k, insurance, life insurance could be part of your estate. You have to be aware of this. If this is a concern for you or possibly somebody that you may inherit from, make sure you do planning now. Don't wait, because if you wait, it can be very costly. That estate tax of 40 to 45% on any amount over that exemption amount is significant. And this is all this is part of the Tax Cut and Jobs Act that is set to sunset at the end of 2025. Here at Steward Strategies, we talk a lot about charitable giving. We believe that we're blessed so that we can be a blessing. And one of the best charitable giving strategies is for a retired person. It's called the qualified charitable distribution. This allows individuals that are over 70 and a half to give directly from an IRA to a qualified charitable organization. When you do this properly, it does not count as income, which allows you to give the gift with pre-tax dollars, not have to declare it as income. And guess what? You can still claim the high standard deduction. You don't have to itemize to get the deduction. If you're using pre-tax dollars for a gift, you're still able to claim a high standard deduction. This is very good tax planning right here. But again, this only qualifies for folks that are over 70 and a half that are given directly from a retirement account. If you have questions on the strategy, please reach out to us here at Steward Strategies. We love helping our retired clients give money to organizations that matter to them and their families the most. If you're in Sunday school class and you're a retiree and you've got other retirees in your Sunday school class and you all give to your church or ministries, you should really consider qualified charitable distributions as part of your overall financial plan and tax strategy. So we've got to keep in mind that the current Tax Cut and Jobs Act, the low tax rates we're seeing right now, the low estate tax exemption, some of the other favorable tax treatment that we're seeing right now is set to sunset at the end of 2025, and we are expecting some 2026 changes. Individual income tax rates will most likely change. The estate tax exclusion is going to go back down to pre-2018 levels. Now, the cap on your deductions for state and local taxes, that will disappear, so that will help some folks when it comes to itemizing. The child care tax credit is going to go back to $1,000 and the AMT will revert. So be proactive. Would you rather do proactive tax planning or reactive tax paying? So an ounce of prevention is better than a pound of cure. Be proactive and not reactive when it comes to your tax planning. It's much better to take small steps today that could lead to much greater results later on down the road. Think about it. Every little bit of tax plan we do now could have a lifetime impact for us and potentially our heirs as well. One of our goals here at Steward Wealth Strategies is to not just help you with tax planning, but to keep you updated when tax laws change so that you can be a good steward and make wise decisions. So what should you expect from us? You should expect regular reviews of changes that may affect you, communication, frequent discussions, and also you should expect us to stay on top of economic, tax, estate, and investment issues for our clients. If you know somebody that could benefit from this information, we're talking about taxes. Everybody you know is probably affected by taxes. A family member, a friend, a coworker, somebody that you care that really is probably one to think proactively and trying to reduce taxes. Please share this information with them. Help us help others. We love to talk to our clients about how they can be better stewards, and we would love to help people that matter the most to you. Our best clients come from our clients. So I want to just close out and say thank you. You know, as we enter the season of Thanksgiving and also the holidays, as we celebrate Christmas and we wrap up 2023, we at Steward Wealth Strategies know that, hey, look, it's been a tough year for a lot of folks. There's been a lot of volatility. There's change around the corner. And our relationships with our clients matter a lot to us. So thank you for blessing us with the opportunity to serve you. And I hope you have a great Thanksgiving and Christmas and New Year's. Enjoy the holiday season with your family. God bless you. Thank you very much.